Good morning, boys and girls, ladies and gentlemen. I'm Uncle Pete. This is Uncle Pete's Wall Street. Welcome back. I want you to take a good look at this chart. This is something I've talked about in my previous videos. And by the way, this is the final video in my beginner series on investing in the stock market. This is video number 7. I've spoken about this. This is the S&P 500, right, which I explained before is an index of the Standard & Poor's S&P 500. It's essentially a gauge of the overall market. What is the market doing? So take a quick look at this before I get into the topic of today's final video is the 10 rules of long-term investing. I'm going to get to that in a second, but take a look at this video and I have a question. Looking at this chart, now, the chart begins way over here at the bottom left back in 1998, and it goes to today, 2025. That's just 27 years. And what are we looking at here? Well, there's a question here. What do you need to see to get you to understand the power of investing in the stock market and not selling when the market tanks? Look at all the left here. A lot of you people are too young or you weren't even around at 9/11. The market sold off very badly after the terrorist attacks of 9/11, September 11th, 2001. In fact, the market was closed for several days after that because lower Manhattan was such a mess. Okay? And despite that, we recovered. Shortly after 9/11, we were at war, and that hurt the market as well. The market recovered. Many years later, in 2008, we had this subprime mortgage mess. For those of you who don't know, the subprime mortgage mess was people were taking out mortgages they couldn't afford, partly due to rules forced on banks to make home ownership available to everybody. So the government made laws that forced banks, if banks wanted to expand their operations, they forced them to make loans in what they called red line districts, where people who didn't have good jobs, didn't have income, histories of income, they forced banks to give mortgages to people. And then what did the banks do? Of course, they didn't want to hold on to that toxic paper, so they pooled it with good loans, and firms made financial instruments out of it, subprime mortgages, and eventually the house of cards collapsed, and this was the end result. It's a combination of government stupidity and greed by companies and stupidity by companies. But anyway, you had this huge mess in the stock market where the S&P 500 got creamed, and yet it recovered. Then let's go all the way over here to 2020. You have COVID. Look at this huge drop in the stock market, and yet it recovered. And I have all these little red arrows here. You would think I was colorblind. I have these red arrows here showing various corrections in the stock market over the years. Boom, 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 right? and yet the market recovers after these corrections. So what's the lesson here? The lesson here is to stay invested. Don't get sucked out of the market because of these huge, scary events. The market recovers. So you can imagine the people who were buying here and 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 buying here, all these corrections. What are their portfolios worth today? Right? So I wanted to just start off with this to repeat what I've said in the last 5 videos. And remember, I told you in my last video or the one before, I can't remember, that repetition is the mother of all learning. You're hearing me repeat these same themes over and over again, not to get scared out of the market. And this is why. Here it is in black and white. This is facts. You can't dispute this. This is what the market did during these tragic events, and this is where it is today. This is just 27 years. Imagine if you were in the market 30, 35, 40 years. If you're 22 years old right now, 40 years, you're 62. I'm not saying the market's going to do this again, but who knows? Who knows? Maybe it'll do even better the way technology is, right? Maybe you'll have better returns in the next 40 years than I've had over the last 35, 40 years, right? So I hope you see that this is why you don't quit. You don't quit the market because the market won't quit you. All right. So let's get to the 10 rules of long-term investing. Okay. Here we are. The 10 rules of long-term investing. How to succeed as an investor in the stock market. Hopefully you're paying attention. Rule number 1, plan and be consistent. What is your plan? What are you going to do? You're going to contact a broker, right? First, you're going to see your tax advisor and say, I want to open up a retirement account. Your tax advisor who knows your financial situation. I don't know your financial situation. You have to talk over with your tax advisor and ask them, what is the good retirement plan for you? If you don't have a tax advisor, ask someone you know. Ask a parent, ask a grandparent, ask someone at work, ask somebody to put you in touch with an accountant, a CPA, right? They know your situation. You're going to tell them your situation. They'll be able to advise you. So once they advise you, you know, if you're at work that offers a 401k, my God, open up the 401k, start funding it, especially if your company matches it, right? Okay, so what is your plan? A 401k, an IRA? I have to fix that, right? An IRA, index mutual fund, index ETF, right? So you're going to open up your brokerage account. You're going to open up your retirement account, and you're going to fund it with money, and then you're going to decide what you want to put in it. Are you going to buy an index mutual fund, an index ETF? Just get started. That's the thing. Just get started. You can always change things up down the road. All right? Plan and be consistent. Next, stick to your plan and be consistent without fear or apprehension. I showed you the chart before at the beginning of this video. There's no reason to fear or be apprehensive, right? Figure out how much money you're going to put into this account every month. And I would tell you, you should be putting 15% of your income in a retirement plan. Okay? Stick to your plan and be consistent. Make sure that 15% goes in your account every month. Link it to your checking or your savings, wherever your paycheck goes. Link an automatic investment into your brokerage account. And don't let market volatility or violent correction stop your plan. Go back to the chart from the beginning of this video. Tell me why you would ever sell on fear of human events, of world events, right? They are scary. It looks terrible. I'm going to lose all my money. They recover. Things recover. Okay. Number 2, dollar cost averaging. Right? All dollar cost averaging is you put the same amount of money into your retirement account, into your investment every month without fail. Why? Because it reduces your overall cost basis of an investment over time. Some months the market is going to be lower than other months. So if you put $200 in your investment in January, right? It's going to buy so much of your investment. Maybe February the market corrects and your investment price, the price of what you're investing in, the ETF or mutual fund or whatever, is lower, right? You'll buy more shares. And over time, that reduces your overall cost basis of the investment, right? So that over time, as the investment grows and the price of the investment gets higher and higher, when it corrects because your cost basis is lower, you won't be scared, right? Or you shouldn't be. Next bullet point here, invest the same amount. As I mentioned before, remember I told you, repetition, preferably at least 15% of your income in a long-term retirement plan, such as a 401k, a regular IRA, a Roth IRA, or whatever tax advantage retirement plan you're eligible for. Ask your tax advisor, okay? Get your money working. Just get it working. Get this thing opened up and funded and start your plan. Over time, you're going to learn. You're going to read. You're going to make personal finance one of your top priorities in your life. Why? Because you're an adult. And it's one of the things you have to do as an adult. Personal finance is incredibly important. It's just as important as your health. Right? So you're going to become educated more and more over time. And you might, in the future, you might feel like, hey, I know what I'm doing now. I want to switch things up. Instead of the S&P 500 ETF, I think I'm going to move some of my money or all of my money over to the total stock market ETF, right? Or whatever you want to do, right? But dollar cost average. Number 3, very important. Reinvest all dividends. What are dividends? I mentioned this in a previous video. Dividends are cash payments from the companies you own, usually paid out every 3 months. Reinvesting dividends reduces your overall cost basis over time. Just like dollar cost averaging reduces your cost basis over time, because some months the price of your investment is lower than the other months. Reinvesting dividends is free money from the companies. So let's say if you own the Vanguard Index 500 mutual fund, it holds 500 companies, right? That make up the Standard & Poor's 500 index. Many of those companies pay a quarterly dividend. They pay the dividend into the fund, right? And then the fund pays the dividend to you based on how many shares you own of the fund. You reinvest those dividends into more shares of the fund so that when the dividend is paid again in 3 months, you buy even more shares because you have more shares because you bought more shares with the reinvested dividends. All right. And I'm gonna make a point about this um, later on in one of the later rules of investing. Okay, so reinvest all dividends, and it's very simple. You just contact your broker and tell them I want to reinvest all dividends. Or if you're savvy enough, you could do it right online into your account. Number 4, your whole time is forever. Right? I don't know how many times Warren Buffett has said this when people ask him, "What's your whole time?" Forever, he said. Your retirement plan is an investment that you never sell, right? Until you want to enjoy your money in retirement. So let's say down the road, you're in your 60s or late 50s or whatever, and you want to retire. And you have this investment that you've been nurturing for the last, I don't know, 35 years, 40 years. You might say, okay, I'm ready to retire. I want to start living off of um, the dividends of this account. So you could have, let's say, 4,000 shares of this mutual fund that's paying you a dividend. You can contact your broker and say, stop reinvesting dividends, send me the check. All right. Bullet point number 2. If you sell your investment before you retire, you will not reap the full benefits of the investment when you need it most in retirement. Don't sell. Resist the urge to sell no matter what the market does. Okay? Go back to the chart that I showed you at the beginning. See the chart of the S&P 500 and what it's done over time. Okay, rule number 5. Do not take early distributions. What are early distributions? You have a retirement plan and you pull money out of it. Bullet 1. If you have an emergency and absolutely need money for your retirement plan, see your tax advisor about the tax ramifications from taking early distributions. The current rules are by the IRS, if you're younger than 59 and a half and you pull money out of a certain retirement plan, not only are you going to pay tax on the money you take out, you're going to pay a 10% penalty. Okay? Bullet number 2, if it was me, I would try everything possible before taking an early distribution from my retirement plan. Why? Because when you take money out of your plan, you take your best team out of the game. And that money can't work for you if it's not invested. Right? If you're 10 years into your retirement plan and you're planning on investing in this for 35, 40 years, you pull money out of it, you pay tax on it, you pay um, a penalty, but worse, you're taking your money out of the game. So now that money can't compound over the next 25, 30, 35 years because you've removed it from the game. It's out. Think of how much money you're losing. It's if you take out $5,000, are you just taking out $5,000 from your account? No. No. Because if you earn 12% in that fund, that $5,000 doubles every 6 years. Right? So multiply that for 36 years. That's a lot of money you're taking out. You're destroying yourself there. So If you have an emergency, find some other way, and absolutely talk to your tax advisor before you do something like that. Rule number 6, don't borrow from your retirement plan. If you have a 401k, there are ways you can borrow money from that, but it is an absolute mess if you do that. Once again, you have to see your tax advisor before you borrow money from your retirement plan. Anytime you're using money, right, for something, you have to be aware of the tax consequences of what you're doing. So you have to talk to your accountant before you do something like that, right? Don't borrow from your retirement plan. Find some other place to get the money before you absolutely do something like that. Rule number 7, be smart with all your other finances. Right? If you're smart with all your other finances, the chances of you being in a bind to the point where now you're looking at pulling money out of your retirement plan, the chances of that will be far less. Don't do stupid things with your other finances that could force you to need money from your retirement plan. Right? Don't be stupid. Bullet number 2, ask yourself, can you really afford the house you want to buy? Meaning, will the PITI, the mortgage, the principal of the mortgage, the interest on the mortgage, and the property taxes and the homeowner's insurance, PITI. If the PITI on the house that you want to buy is more than 25% of your take-home pay, I'm telling you, you can't afford that house. If it is me, in my opinion, I would not buy that house. I've owned a lot of homes in my life, and I never, ever had a mortgage where the principal, interest, taxes, and insurance were more than 25% of my take-home pay. Never. Never. And you know what? I also never bought a house without putting 20% down as a down payment. And you know what? I never got in trouble with a mortgage. Never. I never, ever missed a mortgage payment. All right? So you do what you want, but I'm just telling you, in my opinion, you cannot afford a house if the PITI is more than 25% of your take-home pay. You can't afford that house and live comfortably. You will jeopardize your retirement plan because you will eventually, that house, those payments, and all your other expenses are going to catch up to you, and you're going to be looking for places where you have money. And you're going to be looking at your retirement plan, and you're going to hurt yourself. Right? Don't be stupid with your other finances. Ask yourself these questions. Can you afford that house? Do you really need another kid? Can you really afford that boat? Etc., etc., etc. All the shiny things that you want. Don't be stupid. Rule number 8. Don't ever listen to broke, negative people. I'm going to tell you right now, bullet point number 1. You will run into people who will tell you the stock market is rigged. Maybe you should take a picture of that chart of the S&P 500 over the last 27 years and show them. And when somebody says the stock market's rigged, show them that picture. Say, where's it rigged? Right? Bullet point number 2. You will run into people who will tell you they know people who lost all their money in the stock market. You know what? I know people who lost a lot of money in the stock market too. Never took me out of it. You know why? Because those people sold out of fear when the market corrected. Or they bought stock tips and got destroyed. Right? In pump and dump schemes. They didn't invest with intelligence and knowledge and rationality and prudence. They're just all over the place throwing money at stuff. I know people who lost a lot of money in the stock market too because they were dumb about what they did. Put all their money in one tech stock. You know? Don't be stupid. Don't listen to broke negative people. Bullet point number 3. You will run into people who just don't understand investing, who are too damn lazy to educate themselves, and the only thing left for them to do is to scare you out of the market and drag you down to their same financial hellhole. There are people like that, friends, family. They're like that. They're like that. They're jealous that they just afraid to read up, educate themselves on investing, or they're too damn lazy. They just want to be negative people, right? If you think you can reason with them, try. If you don't think they're receptive to reason, then let them fall. Ignore them. All right. Rule number 9. Don't get discouraged in the early years. Okay. Bullet point number 1. The power of compounding interest takes time. It takes many years to actually look like something. And I'll tell you right now, every time you invest new money in the market corrects. Every time. It's happened to me all the time. Every time. I get a chunk of money from something, I dump it into the stock market corrects. Right? It happens. It happens, but you stay the course. And in the early years, right, you're putting money in and it just doesn't look like something. But I could tell you what shocked me. Well, I wasn't very shocked because I understood this stuff, but it was still a surprise because of what the stock market has done over the last bunch of years. I was surprised, I guess, at how much in the later years of my investing, 35 years later, how much is actually in there. And it was amazing that when I got laid off from my job after 22 years, when I was 57, I felt comfortable not to go back to work. I haven't worked. I got laid off in October 2019. I had one job between 2019 and now, 18 months as a margin operations consultant for a broker dealer. And I took the job because the money was great and it was 100% remote. Right? It made no sense. It was during COVID. It made no sense for me not to take the job. Right? I took it. It was great money. And that was it. But I felt completely comfortable at 57 years old not to have to go back to work. I'm not looking for a job. Right? So it doesn't look like anything in the early years, but in the later years, you're going to be so happy. All right. Bullet point number 2. In the early years, market corrections could produce paper losses. If you sell out of fear, you're going to turn those paper losses into real losses and you'll have to start all over again. I showed you the chart. Let the market do its stupid dance. If you have money on the side, invest more. If you don't, then just hold. Remember in one of my previous videos, I talked about one of my mentors in the stock market, Louis Rukeyser, right? He said, when the going gets tough, go to the movies. Don't sell when all the dumb people are selling, right? Warren Buffett said, you make your fortune in a bear market. He also said, be greedy when others are fearful and fearful when others are greedy. When everybody is selling, you've seen the headlines of the stock market, right? The scary headlines. People who know better, people who are rational, who act like adults, we go in there and buy when the market is having a conniption fit. We don't sell like everybody else. All right. Last bullet point in rule number 9. When a market corrects violently, your ignorant and negative family members and friends will tell you, quote, I told you so. You didn't listen to me, end quote. Let them talk. When you're enjoying life in your 50s, 60s, 70s, and 80s, they'll be scrounging for money and looking for another job to put food on the table and pay their bills. It's sad to see, but go into any Walmart, Home Depot, and 100 other retail stores, and you'll see old people working there. In the decades to come, your negative friends will be replacing them in those stores, in those jobs. You don't want to be one of those people. Okay. Rule number 10, the final rule, be coachable. Right? What does that mean? It means be thirsty for knowledge. You have 2 ears and 1 mouth for a reason. You should listen twice as much as you talk. Listen to people who are positive. Listen to people who are successful. Be thirsty for knowledge. Keep reading. You're not going to understand everything you read, but if you just keep reading, in time you will understand. I recommended 2 books in the last video. You're not going to understand. If you're very new to this, you're not going to understand a whole lot in those books. Don't worry about it. If you take one concept out of reading a book, you're one concept ahead of where you were yesterday, right? Bullet point number 2. Have a curious mindset to become educated about investing. Read, read, read. Uncle Pete, I don't like reading. I don't care. Start reading. Become a reader, right? Bullet point number 3. You want to be successful? Become a reader. Don't be one of those people who are afraid to read because they're afraid they're not going to understand everything. And you're going to be made to feel stupid. Don't feel that way, right? Don't feel that way. I didn't get knowledgeable about the stock market and personal finance because I didn't read. And in the early years when I was reading, I had no idea what these people were talking about. I just kept reading. I kept at it. And eventually you get it. So have a curious mindset to become educated. Read. Bullet point number 3. I firmly believe that the number one reason people remain ignorant about investing in the stock market and don't begin to invest is because they're afraid they're not going to understand it. It's scary to pick up a book about a subject you know is so damn important and you don't get anything that they're saying in the book. You watch internet videos, you don't know what these people are talking about. You listen to people on CNBC talking about iron condor spreads, and you don't know what the hell they're talking about. I'm going to tell you right now, you don't ever have to know what an iron condor is. Right? It's totally meaningless in the game of becoming wealthy in the stock market. All right? Don't be one of those people who are afraid to read. Just pick up the book. If you put the book down when you're done reading and you didn't get anything, don't worry about it. Don't worry about it. You did get something. Bullet point number 4. Everyone is lost in the beginning. In our early years educating ourselves on investing, we all put down articles and books and say to ourselves, I have no idea what I just read. That's okay. Just keep going. Keep trying to learn. You will get it. Okay? You will get it. Don't be afraid and don't be just don't be afraid. Don't be afraid to read books that you don't understand. Just keep reading, right? Just keep reading. All right. The last one here is a bonus rule. Don't friggin' quit. Here is the chart, people. It's a chart I showed you at the beginning of the video. What do you need to see to get you to understand the power of investing in the stock market and not selling when the market tanks. Okay? Don't quit. All right. This is Uncle Pete. You've been watching Uncle Pete's Wall Street. I hope you got a lot out of this video. Subscribe to this channel. I have a lot more videos coming. All right. And happy investing. This concludes my beginner's investment series, investing in the stock market. I'll see you in the next video.